This week has been defined by a surge in silver prices reaching levels not seen since 2012 amid escalating Israel-Iran tensions and a cautious interest rate backdrop. Now, gold edged higher, platinum hit decade highs, all surged with safe haven demand, and central banks, including the Fed and the Bank of England, held rates steady while signaling possible cuts later in the year. John Ing is the CEO of investment firm Maison Placements. He joins me now. John, thanks very much indeed for your time.
Good to be here.
Well, silver spiked over $37 an ounce, the highest since 2012 on safe haven demand. That was tied to the Middle East tensions, yet it pulled back slightly. I want to start off with my first question to you. What's your take on the catalyst as far as silver is concerned? And do you see this as a sustained breakout or a short-term spike?
Silver has always tracked gold, and the supply-demand factor is tempered somewhat by the fact that silver is an industrial byproduct of with zinc production, and that there are very few pure silver producers in the world. Thus, there seems, as we have now, when there's demand for precious metals, we are seeing a rush into everything that is precious, and that includes silver. Silver has been lagging, and it's certainly caught up, and expectations are that we're not going to necessarily go to tomorrow to the $50 an ounce level that we saw way back then, but it certainly looks bullish.
All urged above that $78 mark before easing, and reflecting again that geopolitical jitters and speculation around the U.S. involvement in that battle. What's your view on supply fundamentals, John, and risk around, the geography? Are prices heading towards the $100 mark, you think?
Well, we've been there before, and history does tend to repeat itself. But there are other factors at work, including the inventories. And what's happened is that demand has really contracted. Part of it is the electric cars, longer term. That's been a factor. In addition, we've had increased production from Guyana, for example. That's come on stream. We also have the cheating by some of the OPEC nations. So temporarily there are day-to-day shortages, but there's a lot different from when we were at $100 a barrel. It's possible. I mean, if there's a problem in the Straits of Hormuz, after all, 1/3 of the world's supply comes through the Straits of Hormuz. And if Iran perpetuated a blockage, or if there was a sunk ship or something like that, that definitely would be a factor. So it's a very fluid situation. That's one thing about wars that we learn. There is no certainty. The certainty is uncertainty.
And then on the other hand, you had both the Fed and the Bank of England, John, holding rates steady. The Fed sees 2 cuts this year. The Bank of England held off until later. How do you expect the central bank caution to influence commodity demand and currency flows? I mean, especially in the precious metals area.
Well, you hit the nail right on the hammer, right on the nail. I mean, central banks, by virtue of what they do, are very conservative. They are telegraphing, in fact, a holding pattern. And it's logical. No one knows these unprecedented tariffs, potentially the highest tariffs since the Great Depression. They're on hold right now. And whether or not July 1st comes along and whether they're instituted, whether Liberation Day is put on hold for another 30 days or 90 days, neither of the central banks, and nor do I think Mr. Trump knows. So it's a very fluid situation, and my sense is that Mr. Powell is looking ahead. There's no question about it that tariffs are inflationary, and there's no question that it also hurts economic growth. We're beginning to see some initial signs, retail sales, for example. That's been a factor. We're seeing the stocking up in advance. That's been a factor. But you look at some of the employment numbers, there's a lot of mixed data coming out, and so again, by virtue of who they are, central banks are very conservative, and my expectation is that it will keep on. We're not going to get leadership from the central banks, that's for sure.
I want to know how you're relating to that geopolitical uncertainty at the forefront, because there's volatility across energy and metals. How are you managing risk? Are you using hedging strategies like options, for example, diversifying across regions, or shifting allocations towards defensive assets? How are you seeing it?
But what's happened is that some of the, including gold, it tends to be a crowded trade. So gold, I believe, is probably the best Trump trade around. But again, given the volatility, that is not the be all and end all. My sense is that given where the markets are, and the markets are expecting, frankly, very good times ahead. The Magnificent Seven are again magnificent. And my expectation is the market is very much fully valued. So we've been selling, we've been counseling that some of these stocks are double digit PEs, they are expensive, they are on the other end of the extreme, and we see risk ahead. And the risk, we don't know what the outcome is going to be. So therefore, paring back makes a lot of sense.
Yep. And as I let you go, John, just one more. I mean, beyond geopolitics, how are factors like a firm US dollar and signs of global growth slowing feeding into your commodity approach?
Well, the patient is very sick, and the US dollar has corrected 10%. My expectation is that these tariffs have has poisoned the atmosphere. There is if anybody's going to hold US dollars, they're going to want a risk premium. Interest rates, I'm afraid, are edging higher. Borrowing costs are edging higher, and the United States can't afford that. And they're blindly going through the expectation that everything's fine, but it's not fine down there, and they are stretched. So cash is good. Gold is certainly good. And some of these gold stocks look very appealing.
John Ing, CEO of Maison Placements, always a pleasure to speak to you. Thanks for your time.
Good to see you.